Hi everyone. Welcome back to Financial Path, where we break down complex financial topics and help you make smarter decisions for your money. On May 23, 2025, Investopedia just reported that 30-year mortgage rates have hit their highest level in over a year. This isn't just a headline. It's a direct hit to what you can afford when buying a home in a rising rate market. For those who are planning to buy their first homes, this means that they will need to pay more every month for the same value home. This also directly influences how much house they can afford to remain financially comfortable, as with a lower mortgage rate. Before I initiate today's topic, let me show you a list of affordable home values using the calculator Net Affordability Calculator for different annual household incomes. From a list, it is easy to understand that increasing the annual pre-tax income can elevate the affordable home value accordingly, regardless of the current 7.15% mortgage rate or a lower 6% rate. At the same time, we can see how the mortgage rate adjustment from 6% to 7.15% can reduce the house's affordability, even with the same gross income. So, in the context of a rising mortgage rate, it is necessary for us to reconsider the topic of how much house you can afford in 2025. Without further ado, let's dive in. Before calculating what you can afford, we first need to understand what home affordability means financially. Home affordability is about whether you can afford to buy a home without putting yourself under financial stress. That means after paying off your monthly mortgage payment, you still have enough income left over to cover everyday living expenses, pay off any existing debts, build emergency savings, and maintain a decent quality of life. Therefore, home affordability can be understood as still enjoying your financial comfort even after buying your home. Affordability isn't just about being approved for a loan. In fact, lenders often approve people for more than they should realistically spend. The lenders aim to maximize their profits, so as long as the risk allows, they will maximize the mortgage to the borrowers to enable lenders to access the maximum return. Therefore, your affordability is different from the lender's approved amount. When buying your home, your goal isn't to find the biggest mortgage you qualify for, but to find the biggest mortgage you can sustain comfortably over time. The financial comfort isn't defined by one moment, it's about long-term stability, even if unexpected costs arise in the future. This is why we use certain rules and calculators to set clear, realistic boundaries that help us avoid becoming financially overextended. We've understood what affordability means. Then, in buying your dream home and making a purchase decision, we need to know how to put the concept into practice, specifically how to quantify the affordability financially. There are many guidelines for assessing financial affordability. However, the most widely accepted method is based on the 28 of 36 rule, a guideline lenders use to determine the maximum amount they lend to borrowers. Here's how it works. The 28% rule means no more than 28% of your pre-tax gross monthly income should go toward total housing costs. This includes your mortgage principal and interest, property taxes, homeowner's insurance, maintenance and repairs, and any HOA fees. The 36% rule indicates no more than 36% of your gross income should go toward all monthly debt obligations, including housing, credit cards, student loans, auto loans, and so on. For example, you earn $6,000 a month before taxes. Under the 28% rule, your monthly housing budget should not exceed $1,680. Under the 36% rule, your total debt payments, including housing, should not exceed $2,160. This method gives you a safe upper limit. But keep in mind, it's just a starting point. If you have high non-housing expenses or want more flexibility in your budget, you may want to aim lower than these ceilings. Also, remember that the high or low interest rates significantly affect how far this monthly budget will stretch. With today's 7% plus rates, a $1,680 budget buys a smaller loan than it did at 6%. That's why both rate changes and debt levels play a major role in housing affordability. Now, we know the rule typically used when calculating house affordability, but the rule doesn't tell us how much you can comfortably pay to buy a house. Usually, to get the result, we need to perform a reverse calculation by inputting relevant numbers based on some data or an assumption to get the specific affordable amount. If we do the calculation ourselves, it will take much more time. Fortunately, many websites have established calculators that can help you do the calculation. Here, I found that Calculator.net provides an easy-to-use and user-friendly calculator. Once some necessary numbers are input and the Calculate button is clicked, the maximum bank allowable house price and other detailed relevant data will be shown immediately. The calculator can be accessed by typing Calculator.net on Google Search, then finding the House Affordability Calculator under Financial Calculator. The calculator is like the picture, is very easy to use. No registration or email is required. At the end of the part, I want to add an addition. The rule generally gets the bank's allowable maximum house affordability on paper instead of your strict personal affordability. Regarding your real affordability, please continue to watch. Once you know how much home you can afford on paper, the next step is to ensure the number doesn't trap you financially. This is where you need to avoid becoming house poor actively, a situation where your mortgage and housing costs leave you little room to breathe. Being house poor doesn't mean you're broke. It means you've locked too much of your income into your home, leaving too little for savings, emergencies, or everyday living. To avoid this, aim to spend below the allowed paper limit, not at the edge of it. Just because the bank approves you for a certain loan amount doesn't mean that's what you should spend. The bank looks at ratios, not your lifestyle, future plans, or risk tolerance. Think about your full financial picture. Do you have other goals, like travel, supporting a family, or starting a business? Will you need to pay for daycare or elder care in the coming years? If so, give yourself room in your budget. So a smart move is to set your own internal affordability target. For example, instead of spending 28% of your income on housing, aim for 20 to 25%. That buffer can make a huge difference. Remember, your goal isn't just to own a home, it's to own it comfortably with peace of mind and the ability to handle life's surprises. That's what true financial strength looks like. This also tells us the bank's affordability is completely different from your affordability. To ensure a truly comfortable life after buying a home, please always set your affordability below the bank's rule by considering possible future surprises and setting a particular safety buffer. When most people think about buying a home, they focus on the mortgage payment. But in reality, your housing expenses go far beyond that. True affordability must account for all the recurring costs of owning a home. These include property taxes, which vary by location and can range from hundreds to thousands per year. Homeowners insurance is a non-negotiable that protects you and your lender. HOA fees, especially in condos or planned communities. Ongoing utilities like electricity, water, heating, and internet. Maintenance and repair. A good rule of thumb is to set aside 1% of the home's value each year for repairs and upkeep, such as roof work, plumbing, or appliance replacement. These costs are predictable, yet many buyers overlook them. If your mortgage alone pushes your budget to the limit, these additional expenses can lead to financial strain or even debt. So before buying, we need to estimate the full monthly cost, not just your loan payment. We also need to consider both existing amounts and potential increases in the following years. Being a homeowner means planning for the whole picture, so there are no surprises later. Let me first show the maximum affordable house price of the median gross household income of 2023 with the calculator. The annual gross household income of 2023 is $80,610. As for other data, we assume the mortgage term is 30 years, the interest rate is 7.15%, the monthly debt payback is $700, the down payment is 20% of the home price, the property tax is 1.5% of the home value, and insurance is $1,500 per year. After inputting these, we can find that, based on the 28 of 36 rule, the maximum house value we can afford may be $239,477. According to NAR, the median home sale price in the U.S. as of March 2025 was $403,700. If we assume the annual gross household income in 2024 is also $80,610, then, obviously, the income can't afford the median home sale value in the U.S. If you've run the numbers and realize the home you want is currently out of reach, please don't be disheartened, because you're not alone. That doesn't mean you're failing. With higher mortgage rates, tighter budgets, and rising living costs, many responsible buyers are choosing to wait. So what should you do if the affordability estimate feels discouraging? Start with a longer-term plan. Focus on saving a larger down payment. Even 5% or 10% more can significantly reduce your monthly costs. Next, lower your debt-to-income ratio by paying off credit cards or car loans. This not only improves your loan eligibility, but may also help you qualify for a better interest rate. You can also take steps to improve your credit score, which directly affects your mortgage rate. Even a small increase could mean thousands saved over the life of the loan. If location is a constraint, consider expanding your search radius to nearby suburbs or less competitive areas. Many buyers find surprisingly good opportunities just outside major city centers. You can also try some ways to increase your income, such as side hustles, improving your skills to get a salary elevation, and appropriate investments. Most importantly, stay patient. Markets fluctuate, and your financial position can improve with time and planning. The right home at the right time is worth the wait and often leads to a better financial outcome. Buying a home isn't just a financial decision, it's a life decision. That's why choosing a home that fits your goals, values, and long-term peace of mind is essential. Start by defining what homeownership means to you. Is it about stability, investment potential, raising a family? Your answer will guide not only your budget but also your priorities, like location, size, and timing. Resist the pressure to buy now before it's too late. That mindset often leads to rushed decisions, overextended budgets, and long-term regret. Instead, focus on what's right for your specific situation, even if it means waiting. Use affordability tools to set realistic expectations. But also, use self-discipline to stay within your comfort zone. A home that supports your lifestyle and leaves room for savings, travel, or future plans is far more valuable than one that simply looks impressive on paper. Remember, financial security doesn't come from stretching for the biggest home. It comes from building a life where your housing supports your freedom, not restricts it. Choose wisely and let your home be a foundation, not a limitation. If you find this video interesting and helpful, subscribe to my channel for more videos. Your support allows us to continue. Thanks for watching, and I'll see you in the next video.